Okay, so does that all sound good towards the end here? Any questions on that?
Yep, sounds good.
So to be clear, we don't have to write any papers after the guest speaker?
That's correct.
Okay, thank you.
Just, I think because we're just really smashing this all through at the end, I
Yeah,
think it's better if we sit here and just, don't sit there and just, hit mute and go to sleep during all these presentations because I'm not going to write a paper on, but I think listening thoughtfully, asking him some questions, I'll probably chime in with some questions, blah, blah. Then when he's kind of done, he'll go and then we'll start the slides for chapter 14 and you'll kind of get a chance to see the formal lecture and how it kind of, relates to what the guest speaker was talking about.
okay, thank you.
Okay. So the main quiz in here really was, the main testing element was this last midterm we had. And you all did pretty well on that. So I'm comfortable, just kind of moving forward from there with discussion, presentation, question answer, that kind of thing. The last few classes. We only have 3 left counting today. Question? Okay, guys, if there's no questions, then I'm going to start with chapter 5. Okay, let me just get it into slideshow mode here. And let me put myself in tablet mode. Hopefully I won't cause too much of a disturbance. Okay. All right, good. And let's just go ahead and start to take a look at chapter 5, accounting for capital assets and capital projects. Now, when we talk about capital assets, okay, we're talking about things like land, building, machinery. We're going to talk about infrastructure assets, which is kind of an interesting timing because right now, President Biden is talking about investing in infrastructure. And so we're going to sort of understand something that maybe a lot of people in Congress don't understand about what actually constitutes an infrastructure asset. We're not going to say much about intangibles here, okay? Now, this could get a little confusing if we don't stop to think about the 2 different levels of reporting that we have for a government. So remember, if you're a government, primary government, say the city of Hayward, right, you have to prepare your management discussion and analysis, as you well know, and then you have the basic financial statements, and you have your government-wide statements, your fund financial statements, and the notes there too. And then you have the required supplemental information other than MD&A. Well, let's just talk about the basic financial statements. Remember, government-wide statements are prepared using full accrual accounting, the economic resources measurement focus, while at the fund level, we use modified accrual and the current financial resources measurement focus. The capital project fund, our second P in GRASP, as you know, is going to be, or actually it's our first P in GRASP, doesn't matter. It's one of the P's in GRASP, is the capital project fund. It's a governmental fund. It uses modified accrual. When we're talking about the government-wide statements, they will report what? Fixed assets. So we're going to see 2 levels of reporting going on side by side here, whereas we spend money on fixed assets out of, say, the capital project fund or out of, say, the general fund. As we've learned, we would debit expenditure and credit cash. At the same time, the government-wide statements, and again, assuming there's 2 general ledgers, again, we only have 1 general ledger at the fund level, then we convert to the government-wide, but just pretending that we had 2 general ledgers, a fund level general ledger and a government-wide general ledger, well, we would report something as an expenditure at the fund level. At the government-wide level, we would literally debit equipment, and then we would depreciate that equipment, et cetera, okay? So as you look at this, you're going to be seeing that at the fund level, we'll treat purchase of these types of items as expenditure. At the government-wide level, we will treat these purchase of these kind of things as accrual accounting as fixed assets. Any question on that? Okay, good. Let's go ahead then and let's just take a look at the way money will come in for the construction purchase of these items. And sometimes we're going to have bond. We're going to literally deal with the bond issue here. Okay, and one of the examples where the entity issues bonds and then they use the money from the bonds to build a county courthouse. I think I've given my speech in here about how they borrow money in bonds and then they do something ridiculous by like build a prison. Okay, and I'm always like, well, why would you put a long-term financing towards a prison? Now you're going to have to do what? Now you're going to have to keep that prison full to, at a minimum, pay the debt service on the bonds, right? Okay, but sometimes governments will do that so that we could have bonds coming in, grants from the federal government. Okay, often the federal government will say, here's some money that can be used to invest in infrastructure, and that's really what President Biden is talking about doing, is sending what, billions to the state and local level so that they can then invest in various infrastructure projects. Could be transfers from other funds. We're going to see in our example, well, we'll see that once you issue debt, so it's really more in our debt service fund, often it's the general fund that ends up paying the service on that debt. They pay the principal and interest back on that. And then we'll talk a little bit about special assessment. Special assessment is basically when they tax the property holders that benefit directly from a capital project, say building streetlights. And the street lights are going to obviously benefit a particular neighborhood. And so they may do a special assessment on those neighborhoods. Okay. We're not going to talk much about gifts from organizations, and I'm not going to get into capital lease accounting in a governmental setting. Okay. All right. So that's just a peek forward of where we're going. Okay. Generally, the entities that acquire the fixed assets are going to be the general fund. Okay, they often acquire fixed assets like police cars, that sort of thing, computer equipment. Okay, the special revenue fund, and that was one of the first examples we had of a example of a fund where we buy a steamroller, right, that big wheel tractor with a wheel in front of it, and we use that steamroller to for road improvement. The revenue that comes into the special revenue fund would be gas tax, and then the spending of that money could very well be on equipment like a steamroller. And then most of the spending that we're going to talk about here is going to come from the capital project fund. That's why we set up the capital project fund. And there can be, several capital project funds in a government. We open one up every time we say, okay, we want to build a new county courthouse. So what do? We have to get the resources coming in. That's often a bond issue. We have that bond issue, and then we spend that money to build the county courthouse. The accounting for all of that activity would go on in a capital project fund. And the capital project fund exists for that project as long as that project goes on. 1, 2 years. At the end of the capital project, we close down that particular capital project fund. And if there's any money left over, often that money is sent to the debt service fund, since we often issue debt to finance these different projects, and we want to send that money over to the debt service fund. And we're going to go through a detailed example of that here in a little while. Okay, so this is just an overview at this point. Any questions so far? Okay. All right, good. Forgive me, guys. I'm a little parched today. I think I drank too much coffee this morning, so forgive me for gulping water here in front of you. Okay, so let's go ahead and let's take a look at the next slide now. And we can see that the costs that will be used for recording activity with capital assets are typical costs. What is the invoice cost of, say, the equipment? any costs that we have to incur to get the equipment ready for its intended use, fixing it to the building. These sorts of things are all costs associated with the asset. If we do have a donated asset, we bring it at a fair value at the date of gift. You know, that doesn't happen that often, but this is a textbook discussion, and so they kind of consider every single little thing here. But the typical costs associated with acquiring an asset, we will capitalize, at least at the government-wide level, just like you do in commercial accounting. Okay, now again, at the government-wide level, okay, in our governmental activities, we will capitalize those assets. We will literally do the journal entry that you're all familiar with, which is to do what? Debit building, whatever, equipment, whatever the nature of that capital asset is, credit cash, right? Okay. Meanwhile, at the fund level, we would do what? Debit expenditure, right? And credit cash. Now, again, you know, and you're probably getting tired of hearing this already. We would basically what? Record at the fund level and then convert to the government-wide level, and the converting entry would, of course, be a debit to building and a credit to expenditure. And then that would allow us to convert our fund information into our government-wide information. Okay. Okay, good. Now, there are some capital assets that, well, our capital assets are going to be depreciated at the government-wide level. Okay, so once you record that asset, you will go ahead and depreciate that building, whatever it is. So you'll have to keep track of the depreciation on that. Okay, but of course, there are some assets that are not depreciated. And of course, the classic example, it only does that for this set of slides for some weird reason. It doesn't let me, I don't understand. What are you guys doing to these slides? It only does it for your slides for some reason, okay? But basically, the slides for this class, I don't get it. It doesn't let me change anything. But basically, let me try it this way. So irritating. Where am I? Right here. Okay. Why it's doing this. Okay, so I guess I'm going to do it this way, but I'm just going to see if I can get away with it this way. Let's try this. See how it acts. This might be a better way. Are you seeing that on the screen okay? Can you see that slide on the screen?
Yeah.
Yeah, okay. Okay, let's try it this way then. I don't know why it's doing that, but that's all right. This might even be better anyway, okay? So there are some assets that we don't have to depreciate. For example, land. I think you know that, right? Also, if a government has works of art, historical treasures, they do not have to depreciate those. And that makes sense because how does a historical treasure depreciate? Further, we may not even have to capitalize those, period. We may not even have to show them on the financial statements if we meet certain criteria that we're going to see in a minute. And then certain infrastructure assets under the modified approach do not have to be depreciated. And it's not on the next slide, it'll be the slide after that. And we'll talk about that and talk about infrastructure a little bit more. But let's talk about this historical treasure thing, okay? So I keep talking about the city of Hayward. Anybody ever been to Hayward? Didn't somebody live
Yeah.
in Hayward?
I've been through Hayward.
Yes.
Yeah. Lived to tell it, been through Hayward and lived to tell about it. Okay. So what happens? Did you go to the Hayward Historical Museum while you were there?
I didn't go to Hayward to check out Hayward specifically, no.
Yeah, you probably stopped to get gas on your way to something, right? Okay. But what? If you were to go check out the Hayward Historical Museum, it has so much about the history of Hayward in there. It'll take you a full 15 minutes to go through it. Okay. And way in the back, you have to go way in the back. They have 3 pitchforks, and these pitchforks were used to start Hayward back in the day. There's a gold pitchfork, a silver pitchfork, and a bronze pitchfork. And the question is, does Hayward have to even put those pitchforks on their financial statements? Okay. And if you look at this slide here, and I'll try to maybe make it a little bigger so you can see, governments are encouraged, and this comes right out of GASB, by the way, right out of their standard. Governments are encouraged but not required to capitalize a collection, whether donated or purchased, that meet all of the following conditions. So we have to meet all of these. It has to be held for public exhibition. It has to be protected and kept unencumbered, cared for and preserved, and subject to the organizational policy that if Hayward sells one of those historical treasures, it has to use the proceeds to acquire other historical treasure. And if they meet all of those criteria, then they don't even have to put those pitchforks on the financial statements, let alone depreciate them. Okay. Any question on that? Okay, now, spirit of full disclosure, because I always thought my students knew that I was kidding when I talked about those pitchforks. And then I had a student say, I went to the museum, I didn't see any pitchforks. Okay, that's a joke. There's no pitchforks back there. The Hayward Museum, though, is a major disappointment. The Hayward Historical Museum, I had a friend, I said, yeah, come visit me in Hayward. We'll go to the Hayward hour kind of day. We'll grab some lunch, 3 or 4 hours, go to the museum.
Professor, you froze there for a moment.
Yeah, well, just let me know when I'm going to freeze. There's nothing I can do about it. So just tell me and I'll start over. What part did you not hear?
You just stopped at it was your friend invited you to the Hayward Historical
Well,
Museum.
I invited my friend to the Hayward Museum, and I thought it was going to be like this really cool day. And it took us like 5 minutes to go through the thing. So there's really not much in there, but okay. All right, that's all right. Okay, yeah, tell me if I freeze up. It's a little annoying because I got kicked out of my house because they're staging it and putting all kinds of, looks like, somebody who knows something about fashion lives there. Now I was like, nice house. Whose is that? Oh, that's my house. Okay. So I'm having to stay what I think is a nice place, but their internet sucks. So forgive me, just throw a shoe at me if you can't hear me. Okay, let's talk about infrastructure assets now. Okay, and so infrastructure assets are things that are part of a system of assets. So you've been hearing probably in the news that President Biden is trying to put aside trillions of dollars to invest in the nation's infrastructure. And so he's saying, I want that money to go to help improve roads and bridges. And these are traditional infrastructure assets because they're part of a system. If you ever drive on a bridge that is not part and doesn't connect up to a system of highways, don't go across that bridge. Okay, so bridges connect up to other roads and highways. Highway systems connect up to other roads and highways. Okay, but he also has talked about, Biden has investing in water systems. Well, waters, and he's getting pushback from Congress. Congress is saying that's not an infrastructure asset. Yes, it is. It is specifically called out by GASB as an example of an infrastructure asset because water systems, it's not like, you just turn the water on at a faucet on the mountain and the water comes to your pipes. It's got to be going uphill. So there has to be lift stations. Then they use gravity to go downhill. It's part of a whole system. So water systems are infrastructure. Now, what Biden's doing is he's going beyond sort of the 1930s notion of infrastructure and saying, well, wait a minute, infrastructure also includes, access to high-speed internet. And it just is interesting to me that anyone would stand there and say that's not infrastructure. When I first moved into the house that I'm trying to sell now, there was a problem with the internet. They weren't going to be able to get me any internet. And I said, then I'm not moving in. I mean, I need that to do my work. So yeah, internet connects up to a subsystem of other assets. Why would not that be infrastructure? Okay. So all of these kinds of things, if you think of assets that governments are in charge of, that governments own, and how they connect up to a subsystem of assets, water, roads, internet, all of that would meet the definition of infrastructure. And what GASB has told state and local governments is you do not have to depreciate. You still bring them on the books. You still capitalize them, again, at the government-wide level as an asset, but you don't have to depreciate them, but you're going to have to meet certain requirements that we're going to see on the next slide. They call that the modified approach. Under the modified approach, you still record your infrastructure assets, got to show them on your government-wide statement of net position, but you don't have to depreciate them, but you have to meet the requirements that are on the next page. And those requirements are constituted in two required supplemental information schedules. So now we're down to that bottom box. It's not in the MD&A. It's not in the basic financial statements where we call all this out. It's going to be down in the required supplemental information other than MD&A, where we're going to talk about our infrastructure assets. Okay. And those two RSI schedules basically are going to show, that's what those are. Okay. Are going to be documents that the assets are being preserved at or above the established level of condition. So there will be two schedules. One will call out the infrastructure assets. It'll say 10,000 miles of road, and it'll say fair condition, good condition. The other schedule is going to have to compare what you're going to spend to maintain the infrastructure versus what you've budgeted to spend to maintain versus your actual government's required supplemental information, and you can tell what condition their infrastructure assets are in. You could pull San Jose State's not San Jose State, but the city of San Jose's financial report, and they'll tell you in there how much of their road is in good, how much is in fair, how much is in poor condition. And so as part of Biden's infrastructure proposal, I don't know that it came from an analysis of government's financial reports, but there literally are organizations that track the status of government's infrastructure assets, and there was some, tens of millions of miles of road that were in poor condition, and Biden was citing that as part of his whole infrastructure project. So these are all infrastructure assets. You do have to report them. Under the modified approach, you do not have to depreciate them as long as you have an up-to-date inventory of your infrastructure assets, a condition assessment, good condition, poor condition, and estimate the amount needed to maintain and preserve the asset at that condition level, so that the government is gathering that information, reporting that information, so citizens like you know if your government is doing a good job in maintaining its infrastructure. Question? Okay, good. Now, as you acquire infrastructure not infrastructure assets, fixed assets, that's it for infrastructure assets. Fixed assets like a police car, at the fund level, that would be an expenditure. At the government-wide level, that would be equipment. And again, we report things, and I'm not going to keep saying this, guys, because I know it's driving you nuts. We first record things at the fund level, and then we convert from fund level reporting to government-wide level, right? Okay, good. If you dispose of an infrastructure asset, it's reported at both the government-wide level and the fund level. And in this example, they were basically selling a machine that had been fully depreciated for $500. Now, of course, we don't record any depreciation at the fund level, so there's no accumulated depreciation account to worry about, et cetera. And then at the government-wide level, because we would have been reporting depreciation and we would have recorded the original purchase of that asset, and they're telling us here it was fully depreciated, then we would go ahead and credit the equipment to get rid of the equipment, debit the depreciation, accumulated depreciation, because we're now disposing of that asset. And then we would have some cash come in. And since the asset had a book value of 0 and we sold it for $500 cash, we would be reporting a gain of $500. Okay. Now, they talk about reporting other financing sources here, guys. And I will point out, in case you see something, maybe when you're looking at some of the Becker material or something, you might say, well, John, in there, I think Becker takes the approach of calling it other financing sources, but you might see somewhere where they might call that other revenue. Okay. I asked a partner at one of the big firms that does the audit of the city and county of San Francisco, Santa Clara County, City of San Jose. I asked her, so which is it? Is it other financing source or is it other revenue? And she said yes. So basically, she's seen it done both ways. In this class, we'll call money that comes in for a sale of an asset like this, we'll just treat it as an other financing source. Okay. Okay. Special assessment. Good example is these street lights right here. So what happens? Well, let's say I go to a certain part of town, probably a nicer part of town. You know, what's a nice neighborhood in San Jose? I don't know. Is there a nice neighborhood in San Jose? I'm sure there is. There's plenty of Silicon Valley money down there.
Silver Creek, probably.
Silver Creek, okay, gated community, all that kind of stuff.
Oh, yeah.
Okay, good. So we put some street lights up there, right? The city does. Well, what's going to happen? The city's going to assess those people that live in that area for those street lights. They don't pay for it out of general tax money. They account for all of the construction of that, the taxing of that, the paying for the bonds that they might issue associated with that. All of that is called a special assessment. Now, we handle it in a capital project fund that is set up for that project, but we're basically going to tax the property holders that benefit directly from that particular project, these nice street lights here. Okay. Okay, good. Now, what we're going to do here, guys, and this is probably the central piece of the Chapter 5 material, is keep track of a set of transactions that are going to be running through the capital project fund. Now, it's hard for me often to figure out the best way to present this when I'm not in the class and I'm getting to write things all over the whiteboards there in the business building. But let's see, how much room do they give me? No, that's not gonna work. So I think what I'm gonna want to do, I don't know how I got all the way back here. Okay. Is best bet is for me to go to the whiteboard with each one of these. So we're going to have to do the annoying thing of toggling back and forth between the whiteboard, which I'm going to get rid of all this, and looking at the slides. I guess it's not that bad. Okay. All right. So let's just go ahead and let's start to do this. So I'm going to make some T accounts here. And then I'm going to go ahead and look at these transactions and I'm going to tee them up. Okay. So the first one is going to, where's my slides? Be over here. And they're going to get some money from the government to build this city office building from the federal government. So, and we're going to be doing the accounting primarily right here, the capital project fund level. So we go ahead and remember, we get money from the federal government. We're recording that as revenue. Why are we recording that as revenue? Apparently, we know that we are what? We're eligible for this money since they've told us we're eligible for this money for this project. And I guess use may begin, right? And so we go ahead and we treat it as a revenue. We're not testing revenue recognition rules here, but we go ahead and we debit due from Fed for 100,000. And we credit revenue for 100,000. Okay, all right, good. So we got that. Okay, and if there's no appreciable difference between the government-wide, I'm not going to tee up the government-wide account here. It's the same basic thing. Due from capital grants and contributions. Remember, is that I guess this would be considered a, remember we sock the money away, the capital grants. We want to show it on that particular column of the statement of activities at the government-wide level. So we would call it out that way. Okay. All right, good. Then we need some cash, and we need some cash to pay to the architectural company, whatever. And our buddy, the general fund, is going to loan us the money. Now, I'm not going to keep track of the general fund. I'm just keeping track of the capital project fund. So let's go ahead and set up our cash account here. I'm going to put the cash account right here. And they sent me what, 50,000? They sent me 50,000, and I'm going to go ahead and set up the due to general fund because they told me they loaned that money, 50,000. Okay. Okay, good. So now we got a little cash going here, and we don't have to do anything specific at the government-wide level. And so now we can just go ahead and we contract with a construction company to draw us up the blueprints and stuff. So notice we debit encumbrances, credit budgetary control. Yeah, okay, I'm gonna go ahead and tee up my budgetary entries. So back to my chalkboard. So I've got my encumbrances. Right, I got my excuse me. I've got my bud control.
Bless you.
Thank you. Debit encumbrance, credit bud control, right? Okay, good. We're getting there. Okay, now hang on tight, guys. You gotta, this is one of those that you gotta kind of deal with. You gotta grind through it, okay? Okay, good. Now we come over and we take a look at the next slide and notice the actual final bill comes in for 48,000. Okay, now blueprints are part of the cost of a building that you're constructing. So just quickly, just look at the government-wide level. Notice that they do debit construction in progress because we're going to have to keep track of a fixed asset as we build this thing up brick by brick at the government-wide level. At the fund level, notice they're treating that simply as an expenditure because we're dealing with our capital project fund. You spend money out as intended, That's expenditure. You're saying, but John, that's for a fixed asset. Doesn't matter. Modified accrual accounting, you spend the money out, even if you're acquiring a fixed asset, you debit expenditure out of the capital project fund, right? So we go ahead and we're going to credit encumbrance for 50,000, debit the budgetary control for 50,000, okay? And then we're going to debit expenditure. Okay. Debit expenditure, what was it, 48,000? And credit the cash for 48,000. Now I'm going to keep a running balance of the cash. So what do we got? 2,000 left in there now? Okay. All right, good. Did I post everything? Oh, and then my construction in progress. Where do I want to put the construction in progress? I'll just stick it down here somewhere, I guess. It's at the government-wide level. Construction in progress is 48,000. Okay, good. I think I posted everything. Okay. All right, good. Hang in there, guys. This is going to take a couple minutes, and then we'll get to see how this all works out at the end. At the end, it'll be like one of these, oh, what an example, okay? But we got to sit here and stick with this as we go through it. Okay, all right, good. Then we issue a bond, and we issue a bond out of the capital project fund. That's what capital project funds do, guys. They get the money needed for the project. Now, some of it came from a federal grant. Some of it we borrowed from the general fund. Some of it now is going to come in through this bond issue. Okay, so they issue the bond at a premium. 5 million times 1.01 means they're going to get $5,050,000 of cash. They're going to credit this other financing source 5 million, and they're going to credit due to the debt service fund. Now, the reason they're crediting due to the debt service fund is often what a bond covenant will say, is that the bond has to be issued at face or above face. So either at face or for a premium. And any proceeds not used for the construction or any proceeds that come in over and above face have to be transferred over to the debt service fund. And they say this because they want to protect the bondholders. The bondholders are saying, hey, we're giving you this 5,050,000, but we expect you to pay back the principal and interest. So in a sense, that premium money is being set aside to help get started with the money in the debt service fund for the debt service, et cetera. Okay, so we set that due to, and then at the government-wide level, full accrual accounting. And one of the questions we had on the midterm was, how would a bond payable be handled? And it's not recorded at the fund level, it's reported what? At the government-wide level. So even though we're not reporting long-term debt at the fund level, we still would report the long-term debt, just like you learned in your introductory intermediate accounting. We deal with the long-term debt by debiting the cash, crediting the bond payable at face. And since this was a premium, and in a government it generally is a premium, we will credit the premium on bond payable. Okay, so let's just go ahead and let's take a look at our T accounts now. And let's deal with that cash first. So we got what? 5,050,000, is that right? What puts the balance up to 5,052,000?
Correct.
Okay, good. And then we've got what? We've got other financing sources. I'll put right here, OFS. Is going to be the 5 million. And then we're saying that the 50,000 is going to be due I guess well, I don't know. Obviously, now you see why I'm not, an accountant. I can only teach it. That's a joke. I'm just not the neatest guy for writing things on the board due to debt service fund, right? For 50,000. Okay. And I'm not going to worry about the bond payable and whatnot at the government-wide level, but that accounts for that transaction that we saw in the general fund. All of this is going on in the general fund where we sat there and we got that money and it's due to. Okay. Now, since we have some money, let's go ahead and pay back the general fund. Okay, do you mind if we do that right now? Let's go ahead and pay back the general fund because we do have some money and we do owe some money to the general fund. So let's just go ahead and credit $50,000. That's going to give us 5 million. 5 million. How do you write that number? I'm doing it sooner than I wanted to. Hang tight, guys. I'm not going to pay that money back yet. I'm sorry. Because then it's going to mess up my balance. And I don't want to do that. I think what happened here next, okay, we'll pay back the general fund in a minute. What happened here next is what? We got that money from the federal government. Remember, we had set up the due from the federal government. Now they sent us that money. So let's do that first. Okay, so we've got that money that's come in from the federal government. So we're going to credit due from the Fed. And we're going to debit the cash. Now we have 5,152,000 of cash. So we're piling up our cash pretty good here, but we're going to have to spend it on this project in a minute. Okay, good. Then what happens? Then we come over, got that money in. You don't have to do anything at the government-wide level. And now we're going to pay the general fund. So I just got a little ahead of myself there. So when we pay the general fund, because we did borrow some money from them, you come over and you debit due to general fund for 50,000. That closes that out. You credit the cash here for 50,000. And now we've got 5,052,000, right? 5,102,000. Am I doing my math right? Okay. So we still got 5,102,000 there sitting. God damn. 5,102,000. Good. That looks better. Sitting in the cash account. Okay. So now we've got some money. We've got our general fund is paid back up. And now we come over and we take a look and we start to encumber some of that money. So we sign in a contract to construct this thing at 5,052,000. I mean, 5,050,000. So we go ahead and we set up the encumbrance. And of course, I always end up having to move something. I move my construction in progress down a little bit. Put it over here. Construction in progress. What was it? 48,000. Okay. And I go ahead and I debit encumbrance 5,050,000. I credit budgetary control 5,050,000. Okay. And then I go ahead back to the slides. And then here comes the invoice. and the invoice comes in for 3 million. Now, this is not the final invoice, so I don't have to worry about, well, difference between what I encumbered. I won't know until they finally invoice me if there was any difference between what I encumbered and what I actually spent. So I simply debit the budgetary control for the 3 million. I credit the encumbrance for the 3 million. Okay. And then whenever you have construction going, okay, I don't care if it's in the government, in commercial, you never give the contractor all the money up front. You always hold something back. If you give a contractor all the money up front, they're going to F something up, and then you're not going to have any leverage with them to fix something that they do. So you're always going to retain a little percentage here. So we debit construction expenditure for the full 3 million. We credit contract payable for the full 3 million, but we are going to have a retained percentage. But let's just go ahead and do that first, which is debit the expenditure for 3 million. We're going to credit this contract payable. I'll do here. This is all going on in the capital project fund. Contract payable. So liability for 3 million. Okay, now when you come back over and you take a look at the next slide now, okay, we go ahead and we don't pay, as I was saying, the full 3 million. You always hold back a little bit, 5% retained percentage. And by the way, you don't announce this after your, after the contract is already going on. You would have it written into the contract that there's going to be this 5% retained percentage. So we go ahead and debit the contract payable for the full 3 million. But now we're going to set up this retained percentage. It's also a liability. Okay, and that retained percent, what was it? 185,000, if I'm remembering my number correctly, on the retained percentage.
I think it was 150,000.
150,000. Okay, thank you. And then we're going to go ahead and credit cash for what? 2,850,000. 2,850,000. And when I do that, my cash balance now comes down to 2,252,000, right? Okay, and then my construction work in progress, I can just go ahead and debit the full 3 million. Okay, I don't have to have a separate contract payable account because that account's going to be the same either at the fund level or at the government-wide level. Okay, there's my construction work in progress. Would I put 2 million? The hell's going on here? I thought it was for 3 million. What did I do? Lose myself here? 3 million, right? Right. Okay, and they put that into the construction in progress. Be nice if I knew which way to go here. Okay, the construction in progress is right here. That's that 3 million I just put in. Okay. Okay, good. Then here comes the final bill on this thing. And the final bill comes in at what? 2 million. So now that I know that I've received the final bill on this encumbrance, I can go ahead and close out the encumbrance. And notice I debit it for the full, I credit the encumbrance for the full 2,050,000. That closes that out. I credit my budgetary control for the full 2,050,000. That closes that out. Okay. I debit my expenditure for the actual amount, which is what? 2 million. I debit my work in progress at the government-wide level for 2 million. And I'm going to go ahead and credit my contract payable for the 2 million. Okay, so notice we're following our encumbrance rules just like we saw back in chapter 4A, right? You encumber for whatever you estimate, but then you close the encumbrance and you debit the expenditure for the actual, set up the contract payable. Government-wide level, there's no difference in the contract payable, but instead of debiting construction in progress, instead of debiting expenditure, we debit construction in progress. Okay, good. Then we're going to do that retained percentage thing again. We're going to retain 5%. So we're going to go back to our T accounts here. We go ahead and debit the contract payable for 2 million. That closes that out. And then we're going to go ahead and credit the retained percentage. What was it, 100,000 this time? And then we're going to credit cash for what, 1,900,000. Squeeze that in. 1,900,000. And when we do that, we now have what, 352,000 left of cash. All right. And we can go ahead. Let's see if I can squeeze it in down here at the bottom. Well, I already did that. I did the construction work in progress, so we're good there. Okay. Now we come back and we do some final inspections, whatever, and we say, okay, good. They did a good job, or there was a few things that had to be done, but we're satisfied to pay them. So we go ahead and we debit the retained percentage credit cash. Again, in a construction deal, guys, I don't care if you're having your kitchen remodeled. I don't care what you're having. I don't care if you're having somebody pull weeds in your backyard. Never give the person all the money up front. You always want to be able to say, hey, wait a minute, there was that piece over there that you were supposed to work on. If you don't do that, you're going to be left with some undone work. Okay, so that's how you protect yourself against that. So we go ahead now, we feel comfortable that we can pay them the remaining balance that we owe them. So we credit the, or I should say we debit the retained percentage, 250,000. That got rid of that now. And we credit the cash, 250,000. And now I think we've got what, $102,000 of cash left. So we did a pretty good job in this capital project fund, spending the money to construct the asset. Even though we're treating everything as expenditure, that's what our funds do. The money comes in for a specific purpose. The money is spent for that specific purpose, the construction of this office building, whatever it was that they told us way back at the beginning of this monstrosity. Okay. Okay, good. Then we come over and we do our closing entries. Okay, now before we do our closing entries, don't we owe the debt service fund some money? We owe the debt service fund 50,000, don't we? And for some reason, the book decided to just ignore that in the journal entry. So I'm just going to go ahead and do it over here in my T accounts. I'm going to pay the debt service fund because we promised them we would send them that 50,000, right? So we debit due to debt service fund 50,000. We credit the cash 50,000. So that now there's what? $52,000 left in our cash account. Okay. So then we go through and we do our closing entries here. Okay. That's that next slide. So they're going to close all of my statement of revenues, expenditures, and change in fund balance accounts. I have to close all my proprietary accounts at the end of the year. That's not unique to commercial, to governmental accounting. You do the same thing in commercial. So I want to close the other financing sources. I want to close the revenue. I want to close my expenditures, and my fund balance is like my retained earnings. So I'm going to set up my $52,000 fund balance. Okay. So when I do that, I do what? I credit my expenditures for what? 5,048,000. That closes them. I debit my revenue for 100,000. That closes that. I debit my expenditure for 5 million. I mean, not my expenditure, my other financing sources for the 5 million. And to make that journal entry balance now, I think I'll make this red. I've got to set up my fund balance, and my fund balance here is what, 52,000? And we say it's a restricted fund balance because remember, we said, hey, if you finish this project and you got any money left over, that money's got to go to the debt service fund for the protection of bondholders. So we already sent the premium, but now we still have this 52,000. We came in under budget. Beautiful. We got an extra 52,000 that we are not going to say, oh, well, let's use it for another capital project. No. When we issued the bond of those bondholders, part of the bond covenant said any money left over would go to the debt service fund to the protection of the bondholders. Okay. Now, if you look at this from a financial statement standpoint, everything else, show me anything else on this whiteboard here that has an account balance in it above zero. Everything else here, well, the construction progress and what, but at the capital project fund level, we've got cash of 52,000. We've got a fund balance restricted of 52,000, don't we? Is there any other capital project fund account balance that's open here? Okay, good. I'll take that as a no. Okay, so what happens? Well, now we want to close this capital project out. So when we close this capital project out, what happens? We sit here and we will debit other financing uses, transfer out, and credit the cash. Okay, because we want to send that cash, and I'm assuming we're transferring it out to the debt service fund. They don't say that here. Oh, here it is. Okay. Debt service fund is going to get the money. Okay. Now that we're transferring out. So in the capital project fund, now we go ahead and we're going to do what? Other financing uses, transfer out. There's only one other financing use, transfer out. We debit that for 52,000. We credit the cash for 52,000. Now the cash is zero. And then they do what? Well, other financing uses is reported on the statement of revenues, expenditures, and change in fund balance. So it has to be closed out. So all we do now is we credit the other financing sources 52,000. We debit the fund balance 52,000. That money is now showing up in the debt service fund. It's the debt service fund's money. Okay. And when we post that, now we have debited the fund balance 52,000. We credit the transfer out 52,000. This project is closed out. We can close this capital project fund. Everything in this thing is zero. The only thing left we have to do now is at the government-wide level. We simply need to come over and say, okay, government-wide level. We simply take that 5,048,000 that's sitting in the construction in progress. We debit building. We have a building now that we're reporting at the government-wide level. And yeah, we will have to depreciate that. It's not an infrastructure asset. Buildings are not infrastructure assets. Infrastructure assets are things that connect up to other things, etc., like water systems, that kind of thing. Okay. All right, good. So there's that construction in progress, 5,048,000. and debit building. Question? Now, the thing is, John, would I have to be ready to do something this complicated, say on the CPA exam or something for capital project? No. The primary takeaways here are what? We're still using encumbrance accounting. We're still using encumbrance accounting, right? When we get money into the capital project fund and we issue a bond, the bond proceeds are what? Other financing source. If the bond issues at a premium, that money is often sent over to the debt service fund, right? We saw that, okay? As we spend the money, we use our encumbrance accounting throughout. And then what? At the government-wide level, we're setting up a construction in progress. And then at the end of the project, after we've spent all the money, we will, if we have any money left over, that gets sent over to the debt service fund and the project is closed out. Those are the key takeaways. And when you look at this, you already knew how to account for all this. I mean, we learned what we needed to learn. What's that saying? I learned what I needed to learn in kindergarten. People always say that, and then I'm always like, well, I doubt that you learned everything you need to learn. You learned some important things in kindergarten, but not everything you needed to know. But we learned in governmental accounting, we can say we learned practically everything we need to know in what? In chapter 4, really. Okay. At least in terms of the accounting for the governmental funds. Question.
Yes, Professor, what happens if the bonds are issued at discount?
If the bonds are issued at a discount, then we would simply be dealing with that discounted amount of money in the capital project fund, and the other financing source would be less. So it would have been, I don't know, $4,050,000, and the entire other financing source. And then the question is, well, where are you going to get the extra 50,000, assuming we needed that for the project? If you don't need it for the project, then nothing happens. You simply would have debited cash $4,050,000. I'm assuming a $50,000 discount now. You would have debited cash $4,050,000. You would have credited other financing source $4,050,000. At the government-wide level, you would have debited bond payable the full $5 million, and then you would have credited credited bond payable, I should say, the full $5 million. You would have credited cash $4,050,000, and you would have debited the discount $50,000.
Okay, so if the capital project fund needs that 50,000, do we do like other financing uses? I mean, do from debt service fund?
Well, if I received less cash, is what you're contemplating with a discount, right? Then this entry, let's see. This entry here would have been a debit to cash for $4 million, $4,450,000 to make it 50,000 short. Let's just write the numbers. So this would have been 950,000 just to make it 50,000 short. And there would have been no due to, because the bonds, there's no statement that says in the case of the discount, the capital project fund has to find some money somewhere to send money to the debt service fund, because we issued it for less than face. So you simply would have just credited other financing sources $4,950,000. Now, if you're projecting here that they were going to end up $50,000 short to complete this project, then I guess they're going and hitting up the general fund for $50,000.
Okay, I got it. Thank you.
Yeah. I mean, they got to get the 50,000 somewhere. You know, maybe they go back to the federal government and say, hey, can we reapply for another 50,000 on some grant? Maybe there's some sort of, you know, sometimes not really going to governments, not so much. Yeah. If it was a not-for-profit organization, they found themselves short for something like this, 50,000. Sometimes they can turn to community development groups like Habitat for Humanity or the Housing Assistance Council. Habitat for Humanity is the big one on the West Coast. East Coast is the Housing Assistance Council. I did an audit of them because they get some money from the federal government, and then they take that money and they kind of sprinkle it around to different projects that get stuck. Like sometimes a project for low income housing will get money that can only be spent on the homes. And so they can't connect up to the pipes and stuff. Now, I don't know about you, but I don't want to live in housing that when I flush the toilet, there's nowhere for it to go. So they have to get some money from an organization like the Housing Assistance Council that will help them connect up to the city plumbing and that kind of stuff. So it's not particularly relevant to this example, but I'm just by analogy. If you get stuck where you need some more money and, you know, you're just not going to let the project sit there and rot over $50,000, right? You'll get that additional funding somewhere, someplace. Now, what you don't want to do is do something stupid like the Miami-Dade Housing Authority did some years back. And what they did, there was a program called Hope 6. And they got some money out of Hope 6. And the idea of Hope 6 was rather than build these huge towers, they were almost like prisons of public housing that would go up. You know, we don't see them as much here on the West Coast, but on the East Coast, you know, you'll be driving and all of a sudden you'll see tower after tower of building. You'll say, what the heck is that? That looks horrible. What is that? They'll say, that's public housing. And go ahead, move in there someday if you want to, you know, live in a tough place to live, right? So they came up with this idea that what they would do is tear that down under the Hope 6 project, tear all that down, get the money for the tear down, tear all it down, and then rebuild something that might be more like a condo type environment without all of those floors. Well, what the fools did is they tore everything down and then they ran out of money for the reconstruction of the housing. So they just created, I don't know, I think I might have told you guys this story, but they ended up with a bunch of homeless people because they kicked them out of their housing, even though it was bad. And then they didn't have enough money to rebuild the housing. So, you know, you don't want to sit there and be so short that the whole world looks at you and says, you're screwed. You know, and then they ended up having to declare bankruptcy, not declare bankruptcy, but they got put into receivership by the Department of Housing and Urban Development because their financial situation was deplorable. But you don't want that kind of thing. But if you're, you know, 50,000 short, usually there's somebody that'll say, oh, I got you on the 50,000. That's all right. Pay me back when you can, kind of thing. And that's often the general fund. And sometimes the general fund doesn't even tell you to pay it back. It says, here's another financing source, transfer in, there you go, see you around. That's why we have a general fund. Okay. Okay, guys, that's a long example. I realize that, but it, you know, just illustrates some of the basic operation of the capital project fund. Okay. Okay, guys, I don't care about these last couple of slides here. We did talk about the special assessment where we charge those citizens that benefit directly from a project. That was basically those street lights as the example. Okay. All right, let's take a quick break. I feel like I want a break here. So let's take 10 minutes and we'll come back and we'll go through the practice midterm for chapter 5, and then we'll jump into the chapter 6 information.
Thank you, Professor.
Okay, see you. Any questions, guys, about chapter 5 slides before I close these out and move us into the practice midterm? Practice, whatever it is at this point. Questions, example questions for chapter 5?
Nope.
Okay, then let me go ahead and close that out. Geez, I almost hate to get rid of this. This is like my version of the Sistine Chapel here. Let me go ahead and lower it anyway. And let me find my, really? Where's my chapter 5 quiz? I thought I had it opened. I guess I did not. So I think the smartest thing for me to do is open it from Canvas, which I have stupidly closed. Isn't that wonderful? So I go back to Canvas. You still there, guys?
Yep.
Yes.
Okay.
Yes,
Got a-
Professor.
Got a little close happy there, so I thought I might have lost you. Okay, so let me just go to chapter 5. And I want this. And I'm going to go ahead and leave the answers highlighted. I know we tend to get a little more out of it if I don't, but since we're not really going to be tested on this material, I think it's okay if we don't officially test it on. I think it's okay if we just leave the highlights on. Okay. Okay, good. So let's take a look at this first one, equipment in general government service, governmental service that has been acquired several years ago by a special revenue fund at a cost of $40,000, was sold for $15,000 cash. It had accumulated depreciation of 30 existing at the time of sale. The journal entry, and they're asking me journal entry at the governmental activities journal, so that's government wide, would include all of the following except. Now, when I get a question like this, I tend to just like to go ahead and make the journal entry. So they're selling this thing, for cash of 15,000. Okay. They say that it was purchased at a cost of what? At a cost of 40. So of course, when I get rid of equipment that cost me 40, I have to credit the equipment for 40. They tell me that the accumulated depreciation was 30. So if you sell something that had a equipment of 40, accumulated depreciation at 30, at a book value of 10, and if you sell it for 15, you've got yourself a gain of $5,000. Now that's full accrual accounting government-wide level, and I'm not sure you needed to even go through all that to eliminate that, hey, those obviously are part of the journal entry. But you probably could answer something like this quickly by saying, well, look, there is no account called other financing sources at the government-wide level, right? Okay. Now, if we were reporting this at the governmental fund level, say in the general fund, then yeah, we would, well, even then, I mean, 5,000 doesn't make sense even at the fund level. At the fund level, let's just look at that entry. I would debit cash for 15 and I would credit other financing sources, or as I told you, my I don't know, she did a presentation for me at the one of the other universities, and I asked her this question: is it other revenue or other financing sources? And when you sell equipment like this, and she said yes. Okay, so I guess it could be treated both ways here. Other financing source, 15,000. Okay, but that would be at the fund level. This was asking me government-wide. Okay, good. Let's take a look at this one. The following are the City of Beaver Creek's capital assets. What should be reported in the governmental activities column? Well, capital assets used in proprietary funds is too broad because my internal service fund is a proprietary fund, and the fixed assets of my internal service fund would be under the governmental activities column at the government-wide level. So what whoever wrote this question meant to say, they meant to say what? Enterprise fund, okay? If you say enterprise fund, then no, that's not in the governmental activities. That's where? That's business type activity at the government-wide level, right? How about assets used public purpose trust fund?
Isn't that fiduciary?
Well, yeah, except whoever wrote this question was probably drinking when they wrote it, because there's no such thing as a public purpose trust fund. There is a private purpose trust fund, which is what I think they meant. So whoever wrote this question had had a couple of drinks prior, but whatever, they meant a fiduciary fund, and good, we don't report fiduciary funds in other governmental activities. Capital assets of general government, you can tell by the answer, yes. So this question had left something to be desired, right? I didn't write all that. So you're saying, well, why did you pick the question? I don't know. Because it does help us to, with some adjustment, to eliminate things that would not be governmental activities. Okay, good. Number 5, in which of the following funds of activities general journal would not be appropriate to record depreciation of capital asset? Which of the following funds? How about governmental activities? Let's start from D. No, we report the what? The fixed assets there. How about business type activities? Full accrual accounting. Internal service fund, full accrual accounting, we record fixed assets. Capital project fund, yeah, you would not. So that's why it's the right answer. You would not report depreciation in the capital project fund. Okay. Number 6, a city accounts for its capital acquisition using encumbrances. When a city enters into a contract to acquire equipment, the journal entry would be debit encumbrances, credit budgetary control. So even though we're talking about equipment here, and we're talking about an entity, doing a capital acquisition, and you're thinking you're all hopped up on what am I supposed to do in the capital project fund, this gets right back to the same things you already know from chapter 4A, 4B, right? Number 7, 8, and 9, we're going to use this information here to answer those 3 questions. A state constructs an office building. The construction is financed by a transfer of $1 million from the general fund, a grant of $2 million from the federal government, bond proceeds of $7 million, and earnings of $100,000 from temporary investment of the bond proceeds. Now, you look at this question, and is a transfer of $1 million from the general fund revenue? That's a question. Is transfer of $1 million from the general fund revenue?
No.
No.
No, it's other financing source, right? Okay, good. So no, for at least that one. A grant of $2 million from the federal government, that's revenue, right? Okay, so we know we got to pick up that $2 million. Bond proceeds are what?
Other financing source.
And so even though we didn't specifically talk about this in the slides, if you have a period there, okay, and this is sort of an in-practice midterm teaching moment, if you have excess, if you have money from the issuance of bonds and you don't need to use that money immediately for construction, you can invest that money. Now, you can't invest it in junk bonds, okay? But you might be able to put it into, say, a treasury bill or something like that for a short period of time. And any interest that's earned on those funds before you actually begin construction, okay, that money would be considered a revenue, okay? Now, you have to be careful, though. You can't go crazy earning a bunch of revenue on those bonds, investment revenue on those bonds, because if you do, the federal government will step in and say, we're going to take a chunk of that dough because you don't have to pay tax on that money. The bondholders don't have to pay tax on that money, but we're not going to let you play some sort of arbitrage game where you sit here and you just issue bonds just for the sake of getting money to turn around an investment and invest it, and what? And because you're not paying much interest on that money because the bonds are interest is exempt at the federal level. So in effect, the federal government is financing some sort of arbitrage game being played by the state and local governments. So you can't go crazy earning all kinds of investment earnings on idle funds when you've issued federal tax-free bonds. Otherwise, the federal government will step in and expect a chunk of that dough. But if you invest a little bit and you make some earnings on it, that's going to be the key thing to remember, is that's going to be considered a revenue. So you take the $2 million federal grant plus the 100,000 of these investment earnings. That's how B is the answer. Okay. Other financing sources in the capital project fund. That's the ones that were not revenue. The $1 million of the transfer and the bond proceeds are both other financing sources. And then finally, this thing says, well, okay, what would be reported as other financing uses in the general fund? That's the money that the general fund transferred out. So we just asked you a question there from that. Even though this was a chapter on capital project fund, what would be happening in the general fund? Question? Okay, good. I can close this. Okay, let's see if we can do some damage to our debt service fund slides. Where'd they go? Chapter 6. Okay. And let's go to that slide. And again, we're going to sort of be showing journal entries at the debt service fund level, but also we'll show how we're going to be accounting for long-term liabilities at the government-wide level. Again, we don't report bond payable at the fund level. We do report it at the government-wide level. Okay. Now, generally, we have these general long-term liabilities, right, that are backed by the full faith and credit of that particular government. They are typically going to be issued out of, and we saw the example where they're issued out of the capital project fund, or it could be that they're being issued out of one of the, maybe the general fund, maybe the special revenue fund is going to issue some debt, okay? And those debt service will be accounted for the debt service fund. Now, it's important to note that the debt service fund does not account for the service of the debt of the proprietary funds or the fiduciary funds. They're on full accrual accounting. They're going to be debiting cash, crediting bond payable, crediting premium, whatever, amortizing that premium using all the rules that you've learned in commercial accounting for debt. That's for the proprietary funds, which is, of course, our internal service fund and our enterprise fund. That's for the fiduciary funds, the pension fund, the private purpose trust fund, the custodial funds, and the investment trust fund are all going to be using the full accrual accounting that account for their own debt. So what we're talking about when we talk about the debt service fund is accounting for the debt that is going to be issued by the governmental funds, the general fund, capital project fund, the special revenue fund tend to be the ones that issue the debt. And we've already seen the example with the capital project fund from the previous chapter. Okay, so you can see basically the different types of long-term debt, bonds, notes. We're not going to talk about capital leases here. Okay, and then we'll talk a little bit about pollution remediation obligations. Okay. Okay, good. So we have what? We have general long-term liabilities. They're in the governmental activities column. Okay. They are not reported to governmental funds. We have no long-term debt. But what we do have is a debt service fund where we account for the resources that are going to be accumulated to pay back the principal and interest on this general long-term debt. Okay, so say the capital project fund issues the debt, they spend the money, don't they? They spent the money on the construction of that building, whatever. And then I want to get out of this stupid. Someday I'd like to know what happened to my slides that caused them to all of a sudden malfunction on me here, but that's all right. This might actually be better. You can see that okay?
Yeah.
Yeah.
Yes,
Okay.
yes.
Okay, good. Okay, so we are going to see that the debt service fund is going to be sitting here and keeping track of the resources that are going to be accumulated to pay back the principal and interest on those bonds. Because at that point, the capital project fund would have done what? They spent all the money, didn't they? I mean, they sent over what, like 50,000 or something that was left? But for the most part, they spent all that money. So we need a debt service fund whose whole job will be to collect the money that will then be used to pay back the principal and interest on the debt that was basically incurred by the by the capital project fund, but the debt service fund is the one that has to pay it. Okay. Now, very important. Debt service fund does not accrue interest in between interest payment dates. Okay. So they give us this example. Bonds are issued on January 1st and pay interest semi-annually on January 1st and July 1st in the amount of 100,000. So there would be what? There would be an interest payment date. You don't pay interest on the day you issue bonds, but there would be an interest payment date on what? July 1st. And then the next one won't come until what? Until the next year. So what we report as our expenditure for interest is just the payment that was made during that year. Now you sit there and you say, well, wait a minute, by December 31st, we should accrue an interest payable because it's going to pay the next day, January 1st. We do not do that in modified accrual accounting. Full accrual accounting, yeah. And so at the government-wide level, we would accrue that interest. At the fund level, we only report interest expense of $100,000, the July 1st payment. Question? Okay, good. Now, what generally happens, no pun intended, is we issue debt in the, capital project fund. And what the bond covenant reads is that the money that will be used to pay back the principal and interest on that will come from the general fund. So I'm always amazed when I see a bond initiative pass in these proposition XYZ. It'll say, do you approve of the issuance of bonds that will be paid back over the next 20 years to finance the construction of a prison? Money that will be used to pay back the debt will come from the general fund. And the public goes and votes for that. Now, what's happening? We've just spent money to build a prison. We spend that money because we borrow the money, and then the money is paid out of the general fund. If money's paid out of the general fund to pay back debt that we just used to build a prison, do we have that money available for something stupid like, say, education? No, because that money came from the general fund to pay for those bonds. So I never understand why I see the public vote to basically limit their future by saying, yeah, build a prison. The prison will have to keep putting people in it to keep that prison running. Now that we've spent that money to build the prison, we're probably going to hire some private entity to run the prison. We're going to have to pay that private entity to run the prison. So there's going to have to be people locked up in it. Meanwhile, we won't have money for education. I don't get it. Okay. So, but that's what's happening in this case, is that, and I don't know if it was a prison here, I don't think it was, but whatever it is that they borrowed this money for, the principal and interest is going to be paid back by the general fund. So what we're going to see is that the debt service fund is going to sit there, going back to chapter 4B, they're going to have to sit there and estimate what money they think is going to come in. So they're going to have an estimated other financing source of money that they think that's going to come in. They're going to set up an appropriation, and for payments of debt, the legislature appropriates exactly what you need to meet your debt service. There's no such thing as, gee, I didn't know I issued this debt. I didn't know I needed this debt service. You know the debt you issued, so the government, the legislature will appropriate exactly what you need to meet your debt service. So you'll have an estimated revenue, you have an appropriation, those two will match, and then you'll follow your budgetary accounting, except you will not use encumbrances for recurring expenditures like debt service. So now we're going to be able to spend money on the debt service fund without encumbering for that. Okay. All right. So let's just go ahead and take a look at this example. And we issue these bonds, and they call them serial bonds. Serial bonds mature in installments. So for this particular bond, the principal is going to mature $5,000 a year for the next 20 years. As we pay back this $100,000, they are 6% bonds, and so we're going to have to also pay the interest, and the interest amount will go down year over year as we pay down that principal. So the interest is going to be based on $100,000 the first year, and then the next year it's going to be $95,000 and so on. Don't worry, we're not going to go through 20 years of this thing. I'm just going to show you the 1 year so you can see how the money is transferred in from the general fund and then paid out by the debt service fund. Okay, so notice the interest payment dates here are June 1st and December 1st, and they do that so that they will both fall within the current year. Okay, now you come over and the first bond is going to be paid principal payment is going to be paid December 1st, 2014. So you come over and we set up our budget here, and we go ahead and we debit estimated other financing sources, we credit appropriation. That's going to be the 2 interest payments for that first year of $3,000 each, and then the payback of the principal. Now, if you're saying, can you help me out with that $6,000, right? It's going to be $3,000 each. There's 2 payments, $100,000 times 0.06 times 1/2, right? Semi-annual. That's $3,000, and there's going to be one that's going to pay in July, one that's going to pay in December, right? So we need $11,000. Okay, January 1st, December 1st. I mean, excuse me, July, let me look at the dates again. June 1st and December 1st. Okay, all right, good. So we come over and we get that money that comes in now from the general fund. Remember, we're doing the debt service fund accounting. We debit cash, credit other financing sources, transfer in, and then on June 1st, we debit expenditure, bond interest, we credit cash. Notice, guys, very important, We spent that money without encumbering. You do not have to encumber for your debt service, for recurring expenditures, because notice we appropriated exactly what we needed to meet our debt service. Okay, we know what our interest rate is. We know what debt we've issued. We appropriate exactly what we need to meet the debt service, and there's no need for the encumbrance accounting. Then what? Then we go a little bit further into the year, and we're going to have to make that next payment at December 1st. So we go ahead and the money comes in now for the second interest payment of $3,000 plus the $5,000, that first installment on that serial bond that's going to mature. So we go ahead and debit the cash, credit the other financing source. Notice, guys, very important, both bond interest and principal are expenditures. Both are expenditures, okay? And then we go ahead and we credit the cash. Notice that what? At the government-wide level, because we're using full accrual accounting, the $3,000 is still an interest expense, but the principal part is not expense. That $5,000 is not expense. That's a debit to the liability, long-term debt, or right here, the liability, serial bond payable. That is debited to the liability account because we're using full accrual accounting. Important difference, right, between what we would do at the government-wide level and what we do at the fund level. Question? Okay, good. Now, because we're using full accrual accounting at the government-wide level, we would have to accrue that last month of interest because we are paying our interest at December 1st, but by December 31st under full accrual accounting, we do what? We have to accrue the interest. And by then we had paid, $5,000 down off of the principal. So 95,000 times 6% divided by 12 is $475 for that month of December. The debt service fund does not accrue interest in between interest payment dates. Very important. We don't do that at the debt service fund because it's not legally due until what? Until what? June 1st of that second year that these bonds have been outstanding. Question? Then we make our closing entries as we're used to, debit the appropriation, credit the estimated other financing sources, back to chapter 4B, and close our real accounts. Okay. The only thing I want you to understand here is that if you have a term bond, meaning that the entire amount is going to come due in, say, 5 years. For a term bond, we often will use a sinking fund. A sinking fund is like a savings account. Okay, and you've seen savings account calculations before. Johnny is 12 years old and he is going to start college when he's 18. And his parents want to start setting money aside so that he'll have $100,000 in his college fund in 6 years. Interest rate is 3%. How much do the parents need to invest each year to build up to $100,000? Bond sinking fund is the same thing. We have this bond, it's going to come due in 5 years, term bond. How much does the government have to save each year for the next 5 years so that they have the $100,000 available to pay that bond off at the end of that 5 years? And governments will do this to make sure that they don't screw up and, owe money and then have to default on the bonds. And if they're not the federal government, they don't have the full faith and credit of the federal government to just print more money. And so they really do have to be a little more responsible, and sometimes they'll set up a bond sinking fund, okay? So not something that you need to worry yourself about. I think you've dealt with savings account type analysis before, right? This is how much they have to save each year for the next 5 years to have $100,000 to pay this thing off when it's done. Okay. Okay, good. Special assessment debt we've talked about. Special assessment debt is paid by who? Paid by those that benefit directly from that special project, that special assessment project. That's getting back to our little streetlight example. Okay, don't worry about capital leases. We're not going to get into that in this class. Question? Okay, let's jump into the practice midterm then. Okay, for chapter 6 now. So city sells 5 million of 20-year general obligation bonds on October 1st, 2013. Interest on the debt is payable at a rate of 5% per year on the unpaid balance of the debt every 6 months, commencing with March 31st. How should the city report an interest expenditure in the debt service fund for the calendar year ending December 31st, 2013? Now, what's happening? Well, if they're not going to have to start paying any interest until March of the next year, then they wouldn't have paid any interest in 2013. And if that's the case, then my interest expense is what? Is 0, because I have not paid any interest in the year that they're asking me for here. I'm not going to pay it until the next year, so it is 0. Okay. Okay, good. Let's take a look at number 2. A city keeps its books on a calendar year basis. On April 1st, the city sold 500,000 of 6% general obligation bonds payable in semi-annual installments. The first installment due October 31st, 2013 covers interest of 15,000 and principal of 20,000. For the year ended December 31st, 2013, how should the debt service fund? Well, look, they did what? They paid, right? They issued the bonds on April 1st, but the first interest payment date came October 31st, and that was all they paid in 2013. Since that's all they paid in 2013, the 15 plus the 25 is going to give me this 40,000. Okay. When bonds are sold at a premium for a capital project, the premium amount is generally, we talked about this, gets transferred over to the debt service fund, right? The city of Harrison fiscal year ends December 31st. On July 1st, the city issued $1 million of 6% 10-year term bonds with semi-annual interest payments due on July 1st and January 1st each year, beginning January 1st, 2015. What amount of expenditure should the city recognize in the debt service fund for the year 2014 and 15? Okay, first of all, I'm not going to pay any interest in 2014. It tells me that the first interest payment comes what? In 2015. So this was an easy question just by realizing that. But then you sit there and you say, well, okay, look, if it's $1 million bond and it's what? 6%, and then I take half of that, that's 30,000 that's going to get paid in January of 15. And then there'll be what? In the next 6 months, 6 months later in July of 15, they'll pay another 30,000, won't they? So in 15, they'll pay what? 60,000. Now, if you were looking at this for full accrual accounting, you'd want to say what? Well, July 1st, 2014, they issued the bonds. Even though they don't make that first payment until January of 2015, I would have to accrue what? 30,000 of interest at the government-wide level December 31st, 2014, because those bonds were outstanding for that 6 months, right? Question? So you'd get a different answer if I asked you government-wide. Okay, now this one is interesting because you had to read carefully. It says what? Cedar City issues revenue bonds, and they're telling me that it is an enterprise fund. Well, since it's an enterprise fund, what kind of accounting do I have to use?
Full accrual.
Good. I have to use full accrual accounting. So now I'm going to set this up 1 million times the 6% times how many months? Issued the bonds April 1st. What's that? 10/12? Am I doing my math right? No, that's 9/12, right? Okay. Is that how they got the 45,000?
Correct.
Okay. Okay, good. All right. Number 6, general fund of the city of Castle Rock transferred 115,000 to the debt service fund for 100,000 principal and 15,000 interest payment. The recording of this transaction would include, and what's going to happen here, we do have a credit to other financing sources, Interfund Transfer in the debt service fund, right? It's not a debit to interest expenditure in the general fund. A debit to interest expenditure in governmental activities, no. We don't have an account called interest expenditures. First of all, it's interest expense. And the what? The well, I guess that's the main problem. I mean, they're asking me about the transfer, and there is no entry for a transfer anyway at the government-wide level. Okay, so they're asking me about the actual transfer. D, a credit to other financing sources, interfund transfer in both the debt service fund and governmental activities. Again, we don't report, maybe that's the big takeaway from this question. We do not report transfers between funds at the government-wide level. It's just transferring money from one governmental fund to the other. You don't need to report that transfer at the government-wide level. That would be an inter-fund transaction that would get eliminated at the government-wide level. Number 7, the general fund of the city of Castle Rock transfers $115,000 to the debt service fund for a $100,000 bond principal and $15,000 interest payment. Subsequent payment. So the one up there was asking me about the what? Transfer itself. Okay, the recording of this transaction. The what? The subsequent payment on that is a debit to expenditure bond interest in the debt service fund. Now you look at the other choices, a debit to other financing uses, no, that's expenditure. A debit to interest expenditure in the general fund, no, the debt service fund reports that. A debit to interest expenditure in the governmental activities account, again, I think the main problem with that one is we don't call it expenditure, we call it expense. Number 8, this is the same fact, not the same numbers, but same fact pattern that we had in that earlier question. So I'm not going to go back through that. We've already had that. Which of the following assets is not in the debt service fund? Equipment. Okay, there are no long-term assets in our governmental funds. Debt service funds are used to account for the following: payment in principal and interest on general long-term debt. When bonds are sold at a premium, the money's transferred to the debt service fund. Okay, and then the City of Haven issued 20 million of tax-supported bonds at 102 to finance a new prison. upon issuance, how will the premium be recorded? And they're showing the 500,000 as an other financing source in the debt service fund and a premium on bond payable at the government-wide level. Now, if this is kind of showing an alternative accounting for the premium than what we learned. So we learned that what in our little example, did they give me the, yeah. In our little example, in the capital project fund, they debit cash for 20,400,000. They credit bond payable for 20 million. And then they credited what? Due to debt service fund for 400,000. In the debt service fund, they would debit due from capital project fund for 400,000. And they could credit revenue for 400,000. Excuse me. They could credit what? Other financing source for 400,000, because that money is what is going to come to them from the capital project fund, and that money constitutes another financing source because it is money that's coming from the issuance of long-term debt. Okay, so a $400,000 from other financing source of the debt service fund, and then at the government-wide level, it would simply be a premium. Okay.
Professor, does this bonds payable, is it short term?
No, it's long term.
I thought there's no long-term liability in the fund.
Show me. Oh, I see. This bond payable. Okay, thank you. Yeah, I screwed up. Other financing source bond proceeds, right? Yeah, thank you. It's not bond payable, it's other financing source. At the government-wide level, then it's going to be what? Cash 20,400,000, credit bond payable 20 million, credit premium 400,000. Thank you. Yeah, it's not bond payable, it's other financing sources. Thank you. Question? Okay, good. I can close this?
Yep.
Okay, good. Let's take the time we have. Sounds like some kind of song. Let's take the time we have. And let's look at, now you see why I became an accountant, right? And let's take a look at chapter 7, dealing with our proprietary funds. Okay, and when we look at our proprietary funds, I'm just going to come back to this, okay? Remember, our proprietary funds are our internal service fund and our enterprise fund. We're going to use full accrual accounting. We do not have to use budgetary accounts. We will be depreciating our assets, okay? And so the accounting is going to be similar to what you see in commercial accounting, okay? Now, the three financial statements and the thing that is going to be of focus here is going to be the statement of cash flows, statement of net position, like the balance sheet, statement of activities, is like the income statement, and then we'll have a statement of cash flows that'll be similar to the FASB counterpart, but there are going to be some important differences that we are going to focus on here, and mainly the main thing I want you to get out of this chapter. Okay, now when we look at our net position is divided into 3 categories: restricted, unrestricted, net invested in capital assets. So we don't have the 5 categories of constraint that we saw at the fund level. We have 3 categories: unrestricted, restricted, and invested in capital assets. And you can remember that by this little mnemonic that I use, which is RUN. 3 categories of net assets: restricted, unrestricted, and net invested in capital assets. Okay. The operating statement, the statement of revenues, expenses, and changes in fund net position, very similar to the commercial version of the income statement. Revenues, expenses, we're going to have operating income, then we'll continue with non-operating items. Non-operating items are the usual suspects: interest, gain and loss on sale of equipment are non-operating items, and then we don't call it net income, but it's like net income. We'll call it change in net position for the period. Okay, now statement of cash flows, very important. Only the proprietary funds prepare a statement of cash flows. Only the proprietary funds prepare a statement of cash flows. Now when you look at this slide here, I highlight 6 important differences between the government version of the statement of cash flows and the commercial version. Okay, so you can see them here. I'm going to go through them in a little different order than they're listed. First of all, we must use the direct method. We must use the direct method. Okay, for commercial, they say, use indirect or direct. For our proprietary funds, our enterprise fund, internal service fund, for our proprietary funds, we must use the direct method. Okay, even when you use the direct method in commercial, they still make you set up what you do in the indirect method, which is provide a reconciliation of net income to cash provided by operations. GASB is a little more thoughtful about the way they prepare the reconciliation, and they tell you reconcile operating income to cash provided by operations. By doing that, we are able to list certain amounts of cash flow into their proper categories. For example, if you have interest revenue, they will allow you under the GASB version to include that under investing activities, where frankly, it belongs. But in the commercial version, they make you put what? Interest up in the operating section, because they're reconciling not operating income, but net income to cash provided by operations. And so you get stuck doing weird things like putting dividend income up in operating in the commercial version, putting interest revenue up in operating, when really those are investing type cash flows. And then you do the stupid non-linear thing or non-parallel thing of putting dividends you pay out down in financing. And they can do that because dividends you pay out don't affect net income. So the commercial version's a little dysfunctional. The government version fixes that by saying, we want you to use the direct method. And when you provide the reconciliation, don't reconcile net income to cash provided by operations, reconcile operating income to cash provided by operations. And if you do that, then what? Interest revenue can go to investing rather than operating. Interest expense can be broken into either your capital related financing or your non-capital related financing. Okay, and so notice up here they tell us what instead of just having 3 categories, we have 4, and we take our financing activity, and we break it into whether it's related to capital financing or non-capital related financing. And then if you have some interest expense on that, you have to put it into the appropriate category. And then the acquisition of capital assets are treated as financing instead of investing. Okay, so this is a good, if you're thinking about CPA exam type stuff. I did have a dream that a student told me that the only government task-based simulation that they had was to prepare a statement of cash flows for an enterprise fund. And if they ask you that question, just follow your understanding of statement of cash flow for commercial, but instead of doing things like using the indirect method, you have to use the direct method. If you purchase equipment, it's not investing, it's financing. All of that is points for knowing these 6 differences. You walk into that exam praying that they give you a statement of cash flows for a proprietary fund, like an enterprise fund, as opposed to fearing that. Okay, and so you can see here, I showed you the statement of revenues, expenditures, and changes in fund net position. This is like the income statement, operating revenue, operating expenses, right? Non-operating items, but notice right here, operating income. And then when you prepare the statement of cash flows, as we were just instructed, we use the direct method. And then when we prepare the reconciliation, it's not net income to cash provided by operations, it's operating income. And then I gave you a couple of examples of things in terms of, well, more than a couple, a bunch of things as to where they would be reported on a government statement of cash flows. Okay. All right, let's talk about specifics to our proprietary funds now. We're talking about them generically there. They both prepare the statement of net position, the statement of revenues, expenses, and change in net position, the statement of cash flows, both internal service fund and proprietary fund. But let's make sure we understand a little bit something specific about these types of funds. We have a internal service fund, a motor pool. What happens? The city brings all of its vehicles to be worked on by this motor pool, okay? You can't bring your car there, but all the governmental ones, the police cars, the fire trucks, they bring their vehicles there to be worked on, right? Okay. Now, they basically work on a cost recovery basis, okay? And basically what'll happen is the internal service fund will bill the other funds for their work. So if there was some work that was done by the internal service fund for the general fund, the internal service fund will debit due from general fund, credit this account called billings. Be careful, billings is not accounts receivable. Billings is the name of the revenue account that's used for internal service funds. Meanwhile, what's going to happen is the general fund will debit expenditure and credit due to the internal service fund. Okay. Okay, good. Remember our what? Government-wide, our internal service fund is part of our governmental activities. Okay. Enterprise fund is the other type of proprietary fund here. Okay. And notice here that we say revenue from activity rather than taxes or other revenue. Well, actually, I got transfixed by my own drawing. An activity is financed with debt that is secured. Okay, how do I want to say it? Something is accounted for as a enterprise fund if it meets one of these 2 criteria. The activity is financed with debt that is secured solely from the revenue of that activity. So would you be willing to buy bonds if they told you that the bonds were secured by revenue that's being generated by a water enterprise fund? As I drink some water.
Could you repeat the question one more time, Professor?
Yeah, as I drink some water, right? Would you feel secure in buying debt that was backed by the revenue from a water enterprise fund?
I mean, why not? Like,
Well, let me
Yeah,
ask
I'd feel
you,
safe.
is there any way that water will not be used? Okay.
yeah, safe.
So it's pretty safe that there's going to be revenues from water. I mean, that's why the government got involved in charging and providing water, right? We don't want some corporation saying, so people, are you thirsty? Okay, no, we realized way back that water is a commodity that we all have. So we put the revenue, we put the government in charge of what? Of providing that water, although they do charge for it, right? Okay, now for some reason, well, I think the reason because with electricity really started being, given as seen as something as a resource that we all have to have. Later, the invention of the corporation and whatnot really preceded the mass expansion of electricity going to every single house. So we set it up a little bit differently in that we have now what? Corporations that provide electricity. And, I get a little annoyed when I hear PG&E say, well, Pacific Gas and Electric, they tell us, well, we're going to cut off the electricity because we don't want it to start any fires and we're held responsible. And I'm like, hey, all we're asking is that you provide electricity and don't blow anything up. That's all we ask. Okay. And if you can't handle that, we have an organization that can handle big things like providing electricity to everybody and making sure that nothing burns down in the process. That's called the government if you can't handle that. Okay, so anyway, yeah, that's a good case where you would say, yeah, I'm willing to invest in these bonds because I know they're going to have this revenue coming in for the water, right? So if an entity is financed with debt that is secured by those revenues, it's an enterprise fund or revenue from the activity rather than the taxes or other revenue pay for that activity. And so good example there is what? You drive across the bridge, you have to pay a toll to drive across that bridge. And the reason they make you pay that toll is they got to keep that bridge maintained. So the bridge would be an example of an enterprise fund. Now, you could also have shared revenues. And if you have several roads that share gas tax, that shared revenue is seen as a non-operating revenue. It is not an operating revenue. It's non-operating. And that's what I'm showing you in that little picture. Okay. Okay, good. Common types of enterprise funds, water, toll. We don't have toll roads in California, but in many states they do, but we certainly have toll bridges. Okay. All right. I'm not going to worry about these restricted monies here. Municipal landfill, what the federal government does is they tell state and local governments, you're going to have to clean this mess up after you're done filling a hole full of garbage. Okay. And so what GASB does is they tell the state and local governments, well, you're going to have to estimate what your cost is going to be to clean up that mess when you get done filling it full of garbage. And so they have to estimate all those costs. They put all those costs in a pool. You can see the nature of some of the costs that are listed there. And then each year they amortize cost into expense and set up a liability for that as they fill the hole up. So I guess in this example, I assume that they filled up 20% of the hole. If the total estimated cost was $1 million and you filled up 20%, that year you would debit your expense for 200,000 and credit your liability for 200,000. It is very, very similar to what FASB does for asset retirement obligation costs. It's a similar process. Question? Okay, guys, we're not going to have time to finish the chapter 7 practice midterm. So what we'll do next time, I don't think Ali is going to take the whole class time. So we'll decide, hey, do we want to start talking a little bit more about not-for-profit at that time, or maybe give you some time to go off and think about it, and we'll start to cover it next time, but we'll see. Maybe we'll go straight to chapter 14 and we'll leave this government stuff alone. Okay?
Sounds good.
Okay, guys, I will see you. Be here on time. Don't miss class next time because it's the guest speaker, because I get a little, one of my pet peeves is my class doesn't show up for a guest speaker, okay? So make sure you're here next time. All right,
Looking
guys.
forward to it.
Have a good rest of the evening.
Okay, thank you.
Bye,
Bye,
Professor.
Professor.
Have a good one.
Thank you, Professor.